With the sudden rise in popularity of crypto, so many big finance YouTubers have switched to making videos all about these cryptocurrencies. Actual billionaires are endorsing memes like Dogecoin, and 12-year-olds on TikTok are telling me to invest all my money into meme coins like Doge Elon Mars before the rocket takes off to the moon. So I felt the need to make a video about the other side of the spectrum, about a non-speculative investing technique known as dividend investing. So I'm hoping this will be a nice relief for you from videos about risky altcoins, such as Shiba Inu, Hoj Finance, and PooCoin. That's right, there's literally a cryptocurrency called PooCoin, and it has a market cap of $100 million and has returned 80% over the last 7 days. And whilst dividend investing probably won't make you an 80% return in a week, the portfolio I'm going to teach you how to build ensures that you won't lose a large sum of your money and practically guarantees that you'll retire a millionaire, assuming that you invest a few $100s on a regular basis and over a long time horizon. So with that being said, in this video I'm going to talk about how to build a dividend stock portfolio with $100 or just whatever you have available to invest. I'm going to cover exactly what dividend investing is, the pros and cons of dividend investing versus other types of investing, what to look for in terms of choosing good stocks, and thus how to create your own stock dividend portfolio. So if you learn anything new from this video, make sure you hit the like button and comment your thoughts below. And make sure you subscribe because I'll be coming out with new content every week. So first, let's explain what exactly a dividend is. In basic terms, a dividend is just some kind of reward, usually cash, that a company gives to its shareholders on a regular basis in return for holding its stock. And in the United States, dividends are usually paid out 4 times a year on a quarterly basis. So for example, if you buy stock in Coca-Cola, they will reward you for being an investor by paying you a dividend 4 times a year. And if you want to see exactly how much a company will pay you in dividends, you can do so quite easily by going to Yahoo Finance and taking a look at your company's dividend yield. In this case, Coca-Cola has a dividend yield of 3.09%. So this means if you were to invest $1,000 into Coca-Cola, then you would receive 4 equal payments throughout the year of 77 cents. Which totals to $3.09 a year. And I get it, 77 cents doesn't sound all that exciting, but it's a lot cooler when you have more money invested and when you're making money from the company's stock prices increasing, on top of what you're making through dividends. Another point I want to cover is why some companies choose to pay out dividends while other companies don't. Like, why are companies like AT&T paying their shareholders a dividend yield of 6.49% a year, whilst other companies like Facebook don't pay their shareholders anything? Well, the reason is, companies that are more mature and stable have a lot of excess money and have more or less just ran out of ways to expand their business. Since they have limited ways to grow their business, they decide to use their excess cash to pay dividends to attract investors that are looking for a safe and steady income. For example, AT&T was founded nearly 4 decades ago and is the world's largest telecommunications provider. They already have a 40% market share over mobile service in the United States, and they can't really do too much more to expand their business, besides maybe just trying to increase their market share a bit more. So they realize that they have all this cash just sitting around doing nothing, and not many places to invest it to continue to grow their business. So they pay it out to attract people like me and you to invest in their company. This benefits them by raising the price of AT&T's stock, and you can actually find out how much they're paying out in dividends versus how much they're retaining in cash. This is called the dividend payout ratio, which is the amount paid in dividends divided by net income, and in the case of AT&T, it is around 40%. Okay, so on the other hand, why would a company like Facebook choose to not pay dividends? Well, whatever you think about Facebook, and you might be thinking that is just the place for old people and grandmas to watch cat videos all day, the reality is Facebook is still a relatively new company that's expanding its business in many different avenues, such as Facebook Marketplace, which has effectively replaced Craigslist in many regions. So Facebook has chosen to use its excess cash to invest in growing its business through new ventures, and thinks that this will benefit its shareholders more so than paying out dividends. So before we talk about how to choose your stocks and create your dividend portfolio, let's quickly talk about the pros and cons of dividend investing. So the first pro is that dividend income is a very safe and reliable form of passive income. And this is because, like I mentioned earlier, the majority of companies that pay out dividends are large mature companies that are unlikely to face any sort of financial difficulties. So you can feel secure investing your money into very successful companies and receiving money back for doing nothing. Another pro is the ability to compound your returns using what's called a DRIP, also known as a dividend reinvestment plan. This allows investors to automatically reinvest their dividends back into the company so that you can continue to grow your dividend income exponentially. The last pro I wanted to talk about is that dividend investing is a great hedge against inflation. And this is very important since inflation has been dramatically on the rise the past year. And this is because of the government's quantitative easing policy, in which the government is printing trillions of dollars, which is devaluing the US currency. Okay, So now let's talk about the cons of dividend investing. The biggest con is that dividends, although reliable, are not always guaranteed. So at any moment, a company can decide to cut and reduce the amount of dividends it pays. This also affects the price of the stock negatively as investors become worried that the company is struggling, since they can't afford to pay as much in dividends. But soon in the video, I'll cover how you can best choose stocks to reduce the risk of this ever happening. Another con is that because dividend stocks are large companies that pay out their profits to investors, they tend to not grow as quickly as other companies that reinvest their profits into their company for further growth. This means that your stocks will likely not grow as fast as they would if you were to invest into a high growth company that does not pay out a dividend, like Amazon or Netflix. The last con I wanted to mention is lack of diversification. This is because dividend stocks tend to be clustered into certain sectors, such as energy, utilities, industrials, etc. So you won't likely receive the benefit of being as highly diversified as an investor who invests into index funds, in which their investment is spread out over hundreds of stocks in all sectors of the market. Let's move on to what to look for in a great dividend stock, and what type of dividend stocks you should choose specific to your financial situation. If you're a dividend investor, then you want to actually be able to rely on those dividends to be paid to you every quarter, so that you can have peace of mind knowing that one day you can live off of that income. So the most important thing when selecting dividend stocks is to choose stocks that will reliably continue to pay those dividends year after year without cutting or reducing the payment. So how can we identify stocks that will reliably pay their dividends? I recommend choosing dividend aristocrats. These are some of the best dividend stocks you can choose, because to be a dividend aristocrat, you have to fulfill 4 requirements. You have to be a member of the S&P 500, which, to explain simply, is an index of 500 largest and most successful public companies in the United States. You have to maintain a total market cap of $3 billion. You have to have increased your dividend payments for 25 years consecutively. And the last criteria is you have to maintain $5 million in daily share trade value for 3 months. All of these criteria ensure that only very large, high-quality stocks that pay their dividends reliably can qualify as dividend aristocrats. And I want to focus again on the third criteria I mentioned, which is you have to have increased your dividend payments for 25 years consecutively. If you're a dividend aristocrat, then this is such a flex on other companies that your company, through the dot-com bubble in the late 1990s, the Great Recession in 2008, and then, of course, the pandemic last year has not only maintained your dividends every quarter, but also has increased your dividend payments year after year. In fact, since 2014, the Dividend Aristocrats Index has increased the dividend payout 5 times faster than the S&P 500. So I recommend choosing stocks from the list of dividend aristocrats. This list is updated annually, and as of 2021, only 65 stocks qualify to be on this list. As you can see here, each stock is listed out along with which sector the stock belongs to, the years of consecutive dividend growth, and how large the dividend yield is. And if you want to check out the list of dividend aristocrats, I've put a link in the description for you to click on to check that out. So moving on. If you only have $100 to $1,000 to invest, I would recommend choosing around 5 stocks from that list, with each stock belonging to a different sector so your investment can be more diversified. And if you have more money, let's say around $10,000 or so, then you might want to choose 10 to 20 stocks across various sectors in the stock market. Another thing you might be thinking when you're building your dividend stock portfolio is, shouldn't I just be picking the stocks with the highest dividend yield so I can receive the highest amount of dividend income possible? And that's really up to you. Remember when I said that mature companies tend to pay more in dividends than growth companies, and growth companies tend to pay less in dividends than mature companies? Well, the same is true for stocks on this list. As a general rule, the stocks on this list that have a lower dividend yield are more likely to be investing more of their money back into their company to grow their company, to make more money and increase the company's stock price. So generally, but definitely not always the case, if you choose a lower yielding stock, then you're more likely to benefit from the company's stock increasing in price, and vice versa. So I would say that if you're on the younger side and have many decades to invest and compound your money, then pick stocks with lower dividend yields so you can benefit from the growth of these stocks. And if you're on the older side, then you may want to choose the higher yielding stocks, since you won't have as long to grow your investment and might just want to live off your dividend income. Overall, I would try to stick in the 3 to 5% range. Now, I also want wanted to include another simple alternative for researching and selecting individual stocks for your portfolio, if you don't want to bother with the hassle and confusion of selecting any stocks, and want to take the easiest and most diversified route possible to creating your dividend portfolio, then investing into the ProShares S&P 500 Dividend Aristocrats ETF is one of the best options for you. This is basically a fund that consists of all the stocks included in the Dividend Aristocrat list, weighted by market cap. So if you were to put your money into this fund, then your money would be diversified across all 65 Dividend Aristocrats. And I have a feeling a lot of you will prefer this option. So the last thing I wanted to touch on is how you can actually access the ability to buy into these stocks and funds. And you can do this simply by opening up a brokerage account online. You can open up an account at many brokerages such as Vanguard, Charles Schwab, and Fidelity Investments. And if you prefer, you can also use some of the mobile app brokerages such as Robinhood and Webull. So all you have to do is create an account, wait a day or so to be approved, deposit some cash, and start making some good old passive income through dividends. So that's it from me today, guys. Thank you so much for watching, and if you liked the video, then make sure you hit the like button down below. Be sure to subscribe for plenty more content all about personal finance, investing, and all that sort of stuff, and leave your comments down below for what you want to see next. Alright, take care guys, and I'll see you later.